But let's talk about the company which has got the apt name, Happiest Minds. They've reported a very steady second quarter, dollar revenue growth of about 5% on a quarter-on-quarter basis. Rupee revenue growth has come in at 8.1% and margins are absolutely stable on a sequential basis. We're joined by the management of the company, Joseph Anantharaju, Executive Vice Chairman and CEO, and Venkatraman Narayanan, MD and CFO of the company. Gentlemen, morning, Rima here, and happy Diwali to both of you. Venkat, first question is, growth has been solid in the first half of the year. You're tracking a revenue growth of more than 25%. So you look comfortable to meet your FY23 revenue guidance of 25%. But there are two verticals. One of them is retail and the other one is industrial, where you've seen some softness in growth, negative growth on a quarter-on-quarter basis. Can you tell us what's happening for you in these two verticals? What went wrong?
Thanks for that, Rima. Happy Diwali to you and all of CNBC TV 18. Yes, you're absolutely right. Great performance, great quarter, both on the revenue growth, volume growth, and margins front. As far as when you dig into the results a little bit and look at the vertical split, retail has shown a slight drop. We did talk about some sort of a softness in retail and in the markets of Europe for us. That was in the last call as well. But the drop this quarter has been primarily because of completion of certain projects, if you look at it that way, especially in the industrial vertical. Otherwise, all other verticals have grown, secular growth, both absolute and in percentage terms.
So retail is weak because of certain slowness in the European clients, and industrial is because of completion of projects and new projects have not ramped up. Is that correct?
That's right.
And this will persist?
In retail also, we had completion of a project.
Okay.
And hopefully we'll have additional projects coming in from the same client. But industrial was really on account of completion of a project.
In Q3, will there be any verticals where you're a bit worried about growth?
Not right now. Looking at the market sentiment and how Joseph, Rajiv, and other BU heads have really reached out to the market, they are seeing a positive trend, especially for digital. And like we have been saying, digital has become an imperative, so it's not really discretionary to that extent. So even though there is macroeconomic concerns and there is softness in the overall economy, with respect to IT spend and within that digital, we are not at least seeing signs right now. And we are being cautiously optimistic because, things can change. And to that extent, being prepared for it is always good.
All right, gentlemen, good morning and thanks for joining us. This is Pavitra. And, so you mentioned that you're not seeing any kind of, or for now, you're not worried about growth from any of the verticals in Q3. Mr. Anantharaju, if I can come to you now, what would this mean for your revenue then for the full year? And if you have any kind of guidance that you can tell us, it's around 5% this quarter. So can you tell us what it will mean for the full year, since you're saying that, you're not expecting any kind of pain in these individual verticals?
So I think we would like to hold the guidance that we have provided in the previous call. When we spoke of 25% for the year, we feel quite confident that we will be able to achieve those numbers, given what Venkat was just mentioning, that we do see a little bit of sales cycle elongation in Europe, just given the current conditions, both on the political and on the economic front. But otherwise, the US and ANZ, India markets continue to remain strong in terms of demand for digital tech. So we're going to hold our guidance that we had provided last quarter.
Okay, morning, gentlemen. Venkat, wanted to check with you. You have raised about 1,400 crores. Can you take us through what is the plan for utilization?
Hi. We've not yet raised. That was an enabling resolution that was passed at a recent board meeting on October 5th. We have now reached out to our shareholders for confirmation and approval through a postal ballot process. So that's what's on right now, and you would have read about it in the press and through our exchange filings. The next step is obviously to get that approved. The board denominated committee will take it to the next step. Essentially, this money has been raised for growth through inorganic means, acquisition. So we are building up a certain amount of money, or a war chest, as you can call it, to execute on that growth objective.
So what's the kind of war chest you're looking to accumulate? And could you give us some indication of potential acquisitions, the targets? Can it close in FY23?
FY23, there is none as of now. And if it was there, we would have had to go public. And we would like to hold on that front. With regard to the amount of cash, we have about 600 crores of cash on our books, relatively debt-free, and with about approval, in principle approval for about up to 1,400 crores. If we do raise that kind of a number, we are talking about a total war chest of about 2,000 plus crores on our books, if all goes well.
All right, Mr. Anant Raju, just one final question. If you can take us through what you expect on the margin front. And also, we have seen that while your attrition has come down, you've also added, your employee headcount has gone up quite significantly. So can you tell us what all of this is likely to spell for your margins?
Sure. We've given a margin guidance of 22 to 24%. And while we continue to do better than that, we've been 25% plus for the last 9 quarters.
Yes.
And we hope to replicate that, but we want to hold on to 20 to 24%, which is a long-term margin guidance that we provided. And as you mentioned, we've added 393 people net in Q2, of which 247 are campus graduates. And the focus in Q3 and Q4 would be to get these campus graduates trained and induct them into projects so that they can become billable and provide a little bit of cushion from a margin perspective.
Out of time, gentlemen. Thank you very much for joining in. That's Happiest Minds for you, maintaining the FY23 revenue guidance of 25%, margins of 22 to 24% over the medium term. For this year, it's probably tracking a lot higher at more than 25%, but over the medium term, 22 to 24%. But watch out for a potential acquisition. They're building a war chest of nearly 2,000 crore rupees. But this is, of course, in line with the company's long-term target because they have an aspiration to hit $1 billion in revenue by FY31.